Hello and welcome. High-yield funds often come with a very tempting promise of big returns. But what if I told you that sometimes, hidden in plain sight, there's a single sentence in their strategy that unpacks a whole world of risk? Well, in this explainer, we're going to do just that. We're going to take apart one critical sentence to really understand what's happening with your investment.
Everything really starts with this big, attractive promise: capital efficiency. This is the core idea that you can get all the upside of the market, all the growth, all the income, without having to actually buy and hold the stocks themselves. Sounds pretty great, right? But this is exactly where we encounter our first layer of risk. And it's a big one: counterparty risk.
So this is the million-dollar question, isn't it? If the fund doesn't physically own the stock, what does it actually hold? Well, it holds contracts, derivatives, that are designed to mimic the stock's performance. And this subtle shift introduces a whole new player into your investment equation, a third party that you are now completely dependent on. This dependency has a name. It's called counterparty risk. In simple terms, it's the danger that the other side of the trade just won't make good on their promise. They might fail to pay up. And just like that, the fund's success no longer just hinges on the market, it now also hinges on somebody else keeping their word. And the consequences here are really serious. Your investment's performance is now directly tied to the financial health of some other company you've probably never even heard of. If that company runs into trouble, your fund could be looking at massive, unexpected losses. It's all because the fund chose to rely on a partner instead of just owning the asset outright.
Okay, so that brings us to the second hidden layer of risk: the problem of tracking errors.
You see, the whole strategy relies on using these derivatives to create a perfect synthetic copy of an asset's performance. But here's the critical question you have to ask. What happens if that copy isn't so perfect after all? Well, that imperfection, that gap, is what's known as a tracking error. It's the difference between how your fund actually performs and how the asset it's supposed to be copying performs. Because let's be honest, a synthetic copy doesn't always move in lockstep with the real thing, especially when the markets get choppy. So what does this mean for you? It means you might not be getting the exact market exposure you thought you signed up for. The fund can start to drift away from the asset's actual performance, and that can lead to some really nasty surprises in the form of underperformance. The bottom line is, the exposure you paid for just isn't guaranteed. And now we've arrived at the very core of it all. This is the most intricate and arguably the most important risk of the three: path dependency. This whole concept boils down to a single, powerful question. How can one specific moment in time, the very instant a trade is executed, permanently shape the future of an entire investment? Path dependency is this idea where the end result is completely dictated by the specific path taken to get there. The road trip analogy is perfect. Think about it. If you take one wrong turn at the very start of a journey, every mile that follows is on a fundamentally different path. You might never be able to get back to your original route. That single early decision has locked you into an entirely new outcome. So let's see how this plays out for your investment. It's basically a four-step process. Step 1, the fund makes its complex options trade. Step 2, the market conditions at that precise moment set the fund on a very specific performance path. Step 3, from that point forward, that initial path has a lasting, permanent impact on all future returns. And finally, Step 4, that outcome is now locked in. It's completely outside of your control, no matter what you or the market does later. So when we put all three of these risks together, the counterparty risk, the tracking error, and this powerful path dependency, what we get is the conclusion: a massive blind spot for you, the investor. And here's where the conflict really becomes clear. On the one hand, your goal as an income investor is wonderfully simple: predictable, high monthly income. But the reality of the strategy being used is, well, it's anything but simple. Its success is hanging on factors you can't control, like the split-second timing of trades and the financial stability of other companies. This brings us right back to the final clause of that critical sentence we set out to analyze. It says that all of this is, quote, a factor that is largely outside the control or understanding of the end investor. And that says it all, doesn't it? So I'll leave you with one final question to think about, a question every income investor should ask themselves. When you're looking for that steady income, What is the real price you're paying for a level of complexity that you simply cannot control? If you found this breakdown valuable, please do us a favor and click that like button. And be sure to subscribe to FinBot Insights for many more explainers like this one. Thanks so much for watching.